Welcome to the Lindsay Hadley Podcast Show, where weekly I interview some of the world's most inspiring people from business, philanthropy, and entertainment. I love collecting humans, and these are some of my favorites I found along the way. This podcast has been brought to us by Capita Financial Network.
Do you need help with the next steps of your financial plan? Think Capita. Capita is a financial network built around you. They have a team of financial advisors, CPAs, estate attorneys, Medicare providers, and Social Security experts to help you accomplish your financial goals. Call or schedule a complimentary consultation at 801-566-5058 or visit their website at capitafinancialnetwork.com. You can also check out their financial education podcast, The Financial Call, available on Apple, Google, Spotify, and YouTube.
Hello, everyone. Welcome back to the Lindsay Hadley Podcast Show. Today, I have a very talented venture capitalist gentleman from the UK. Excited to introduce John Frankel to all of you. John originally grew up in England and London, to be precise, and had a very prestigious higher education career path, attending Oxford. And we'd love to hear a little bit. First of all, John, thank you so much for coming on the show. Thanks for being here today.
Lindsay, thank you very much for having me. And thank you for that delightful introduction.
Well, we're so excited to learn from you because we'd love to hear a little bit about what is the cutting edge thought process in venture capital right now. I mean, the market's so interesting. You've been at this since 2008, I believe, when you started FF, lowercase FF Venture Capital. And you've invested in some pretty big companies, including Indiegogo, which is a household brand. I mean, tons. You have a whole list of successful bets. And you're in what number fund are you in now, John? How many are you in?
We've raised 6 in the US. We've got 2 in Europe, and we're raising a 7th in the US and the 3rd in Europe.
Incredible. So this is not your first rodeo, and you've probably seen all kinds of things happen in the market since 2008. And tell us a little bit about FF Venture, what your thesis is, how you go about picking, maybe any insights to give our listeners, many of which are major investors, why and how you do what you do.
Well, thank you again for having me on your show. I think the most important thing to understand about venture capital is it's unlike any other investing class. And the main distinction is the illiquidity. And in times when markets go down, people curse the illiquidity. In times markets go up, people don't care. But it's a very strong feature. And because it's a buy and hold strategy over a long period of time, there's a wide dispersion of returns amongst managers. So the bottom quartile, not so great. Median, okay-ish. Top quartile, exceptional. And so we strive to be top quartile in the space, but it requires an iron gut and a willingness to deal through liquidity. Every investment we make, we expect there to be a couple of recessions between first investment and exit, and probably a couple of market downturns. And the relevance of market downturns is really that the multiples that you apply to valuation in the interim before you exit, those multiples can compress and expand.
Yeah.
But not that relevant because the nature of the game is illiquidity as opposed to anything else.
Absolutely. So, I mean, it's a game of patience. Correct me if I'm wrong, but like in general, if you were to see doubling of your money over time for example, in the real estate market, it's usually 7 years. If you're to double your money over time, say in the public markets, in the stock market, you're looking at maybe 10 years. In venture capital, what kind of life cycle or runway do you have, like in a calendar runway with returns?
So if you're really good, you're going to return your LPs 3 times their commitment. And, time period is decade plus. And the commitment is called over the life of the fund. And so it's not like you make all the investment on day one and you get all the money at the end of the life of the fund, but it's more that you're paying your commitment down over time and you're receiving distributions over time. Now, for short life funds, later stage funds, you can look at IRR and you can look at cash on cash. But when you have funds that are a decade plus, those numbers aren't meaningful. In fact, there probably are not any really good, meaningful metrics to measure performance other than cash on cash. And so interim metrics become are very soft. They're level 3 assets, but it's very difficult to really say what a position is worth during that period. Now, the industry average is a third. Let's say you have a portfolio of 30 companies. A third or 10 will likely go to zero. A third or 10, maybe you get your capital back. And the last third, all your returns. And maybe 10% of your portfolio of 3 companies drive all your returns, 85% of your returns. And so, if we've got a portfolio of 30 companies, there's 27 we shouldn't have invested in, but which are they? And so there's very much a portfolio management strategy that we've adopted against this. And so to give you some stats, we try and resolve for higher survivorship of our companies. And so at the seed stage, remember this third, there's another way to think about it is if you have 100 companies you invest at seed stage, which is where we start, 30 raise a Series A and 10 raise a Series B. In our portfolio, about 75 raise a Series A and about 50 raise a Series B.
Wow.
Another way to look at that is what percent of your companies, and that we invest when there's no revenue, get to be $100 million revenue run rate companies. In the mythological language we use in this space, that's not so much a unicorn, though it may be, but it's a centaur. So what percentage of your portfolio becomes centaurs? I'm not sure what the industry average is. Anecdotally, I've heard about 1% for an outlet.
Okay.
We're running at about 11% at the moment.
Wow.
So we do a lot of stuff, and we consider ourselves founder friendly, which is what FF stands for. And we lead to higher survivorship of our companies, which should lead to higher returns when you finally exit. So, VC is not a homogenous business. It's heterogeneous. So late stage VC is more momentum, larger checks into companies that are well established with, hundreds, maybe thousands of employees. Early stage, which is what we do, it may be pre-revenue. They're into companies which maybe there's 4 or 5 people, maybe there's a deck, maybe the company isn't formed yet, or maybe there's some early revenue.
That's really early. I mean, you're a true seed.
Yeah. Right. And the term seed, I think today the kids call it pre-seed. But yes, we like to start very early. And the nature of this is it takes a long time. And there are a lot of things the company can do to trip over the shoelace and have a problem, or to solve that and move forward. And we try and really be there and help them for that.
Cool. Very cool, John. I mean, it's not super common that I hear people in venture capital are doing that early, like pre-seed or angel or seed round. I find that people are trying to do.
Here's our objective. If we're really good, we want to make 30, 40, 50, 100 times on our best investments on our first checks.
Killer.
And we've got a recent exit, or a company we're exiting at the moment. I just looked at it and we're up 8 times. I'm like, okay. Now, in any real world, 8 times should be a good investment. But in nature, where you've got your zeros as well, 8 times is kind of like middle of the pack.
Yeah.
Um,
Interesting.
but yes, that's kind of how we think about the space.
That's so helpful, John. So are there certain verticals that you focus on so that you're hyper focused? Like, are you doing SaaS? Are you doing certain med tech? Like, what are the things that you guys
Well,
tend to look at?
it's a really interesting question, and we've thought a lot about this. Historically, we've tended to be generalists, but in reality, we followed 4 or 5 themes that we felt were strong secular drivers, but we didn't want to be too concentrated in any one theme, just in case by the time you exit a decade later, the world has changed.
Right.
So we had 3 or 4 companies in one of our earlier funds focus on the idea that companies would own their own domains on the web and build their presence on the web and would need the resources to do that. And that was great until Facebook and Twitter and LinkedIn all became closed gardens, and they forced the companies not to have their own domains and need their tools, but to have their Facebook page and have their Twitter page and have their LinkedIn page. And they closed down their APIs. And I think that really took a lot of innovation out of the market. But if we had had a fund focused on that, it would not have been a great fund. So we like a number of themes. I think the themes we're focused on today, there are 2 themes that are overlapping. One is the re-onshoring of manufacturing into the US. So that ties into robotics. We have a lot of experience with logistics and the like. And we think this is a big theme for the next 10, 20 plus years. And we think it falls almost under national security for some areas.
Yeah.
And we think that dollars spent in the US will stay more in the US as opposed to going overboard. And we think the US, to be quite honest, this is the US's century. I know everyone wants to, say the world's ending and the like, but I think the US is doing well, certainly relative to other players. There's been a lot of comparison of US innovation versus European innovation, and it's crazy how much the US is outperforming there. The second major theme is really energy infrastructure. So we think there are areas to play that are not capital intensive in the energy space that require enormous amount of innovation. Now, the driver for that is that energy demand, which historically in the US has grown about 0.5% a year, is now projected to grow. And there are different surveys out there, so this is a matter of precision, but between 2.7 and 4.3% a year. Now that's across the whole country, which means in certain locations that could be 10 or 20% additional generation required.
Wow.
It can't happen. That's impossible. But what's driving it? Well, re-onshoring of manufacturing is part of it. Electric vehicles are part of it. A big part of it is the explosion of AI and the demand for data centers. And the solution, ironically, is going to be application of AI and the application of innovative thinking into energy infrastructure, which has been historically a laggard in adoption of technology. And there's a really interesting chart that I've seen which showed the price of nuclear was going down until the regulations came in and the price of nuclear went up. Now, clearly you need some regulation, but maybe it's an over-regulated space and maybe there's some innovation come in there. The other thing is we believe that the cheapest electricity produced is the electricity you don't have to produce in the first place. So if in the application of AI within certain consumption sides, it's important. And we also think we're going to move from the sort of broadcast distribution model, centralized generation, consumption at the edge of the network, to, and this is over a long period of time, but to local generation, which means you're going to have places that have too much generation, places too little. You're going to need to trade it. Our transmission infrastructure needs changing. And against all that, there's an enormous number of capital intensive projects that will be spun up to solve this. We think there's also capital light, venture backable opportunities there. And again,
Wow.
this is a national security theme as well. So these are two themes that are really capturing our attention. We've had a lot of focus in the past in drones and robotics and applied AI. And honestly, this is just the application of that to energy and manufacturing.
Oh, so interesting. So on average, are you doing, you said 50 companies, 75. How are you putting in 100? Are you making small bets on 100 companies in your average fund?
No, we think the right number to target is somewhere between 30 to 50 on the size of the fund. If you go too big on the fund, you're going to end up just getting medium returns. If you don't have enough companies in, then it's difficult to find that 10% that will outperform.
Interesting. And what are some of the key indicators you look at a company? Since you mentioned kind of like the overall thesis, and I love how you said, if you bet all in one area and that the future shifts, you could be really hosed. But if you have some diversity, but what are some qualities of the founders or the things you look for as you look at some, hey, these are great data points that help me feel more confident, like
Yeah,
past successful
I mean, I'm not
companies?
sure ultimately I'm going to say anything different than any other VC would say, but team is more important than space. That within the team, if you have too many founders, it's a problem. If you have just one, it may be a problem. So 2 to 3. You want the CEO to be a leader. You want them to be strong at sales. Ultimately, all of our successful founders are delusionally optimistic, but not everyone who's delusionally optimistic makes a good founder. And so, against all that, to me, it comes down to passion. So we have this sort of voting mechanism that the investing partner has to really want to invest in this company, and no other investing partner wants to block it. We try to avoid decisions by committee because we think that gets you average results. But you need someone who really wants to, on the weekend, midnight on the Wednesday or Thursday, pick up the phone and, help the founder with what they're working on.
Yes. And so you've got as you kind of look at these founders that are passionate and obsessed and so focused on what they do. Are there other qualities that you notice in their character besides just like general capacity, like good at sales? Are there things that you kind of have
Well, I
noticed
mean,
in qualitatively that become quantitative in clusters? Does that make sense?
yeah, I mean, they're all bright. They all have some domain knowledge that's relevant to the business. They can inspire others. I mentioned being a leader before. And yeah, they're just people you want to work with. They're likable. That to us is really important. And they've got to like you. We won't invest in the company unless they reference us. Because, we're not looking to be just a check. We want to be able to help them. And if they look at us as just a check or we don't like each other, that's a problem.
How big is your actual team, like to run a good VC of your size?
So over time, we've run with large teams, we've run with smaller teams. At the moment, we're a team of about 4. And, we've kept it small. It's kind of funny. It's like when you have a larger team, people seem to need to justify their roles by coming up with objectives that aren't necessarily the firm's objectives, and with views around building teams and try and um, uh, put processes in place that don't necessarily actually drive return. There's a lot of make busy, and
Like
so
trying to be relevant, if you will. Is that what you're
yeah,
kind
I
of
mean,
seeing?
we're at the moment we're running with a leaner team. We're outsourcing a lot of things that can be outsourced, and I can't tell you how much that has freed up the calendar and enabled us to move faster, to get things done. So that's where we are right now. But I'm probably in a couple of years, you ask me, and we'll have a much larger team because I will have, changed my view on this. But over the last 16 years, we've sort of breathed in and breathed out with regard to team size, and this is where we're at today.
What kinds of things, John, do you outsource? Your
Um,
examples.
so accounting is so. Think what this is what a VC does. A VC's job is to fundraise and every now and then get to invest. Which I like, which I kind of like as a thing. But there's LP management, fundraising, and the like. There's accounting for everything, and people trusting you with, you know, hundreds of millions of dollars of assets. You better know where they are. You've got, accounting from portfolio accounting, valuation, tax, regulatory, that you need to dot the I and cross the T. And then there's investing and all the investing process. So, we've looked to outsource some aspects of fundraising, a lot of the aspects on the accounting side. And, on the investing side, what we did, we built internally a system to manage very efficiently a lot of the investing side, from deal flow through to portfolio management and reporting. And about 6 years ago, we looked at this and said, we've built it, we're done. So we can either stop or we can spin it out. And we decided to spin it out. And now there's 50 to 60 VC firms around the world using the same system. And what that gives us is when someone says, hey, I need a new report or a new way to look at this or a new thought process around it, everyone who's using the system benefits. So this system's called Totem. It's at totemvc.com, and it's really good.
Cool.
If we didn't have Totem, we'd probably have to have another 1.5 to 2 associates on the team. It's
That's impressive.
huge time saver.
That's so cool. And do you find that the same people that are good at sales are also good in LP management, or are they two separate types of people?
They're really different types of people. I mean, so there's the process type of making sure that you're getting all the information to your LPs. And then there's the being able to respond quickly to questions from mundane things like I'm having trouble logging into the portal and where's my K1?
Yeah.
Or complex questions. So you need to have something in place to know, who should be addressing those. And then on the fundraising side, that is hand-to-hand combat. That's personal. And so I try and spend as much time I can with my LPs without taking the eye off the ball with regard to the investing side and portfolio management side. In fact, yesterday we hosted for our LPs a webinar with 5 of our companies talking about AI, because we started to hear from LPs that they don't really understand AI. Now, we've been investing in AI as a theme, that we've had companies with AI embed them before that, but as a theme for the last 8 years. And so we thought it was a good idea to get some of our companies on and talk about how AI enables them to do what they do that they couldn't do elsewise in terms of revenue, in terms of product. And then also internally, what AI tools they use and how they use them. Because I think that it is both a space that's underhyped and overhyped. And we thought this would give some context. So, we run those kinds of educational things as well for our LPs.
That's great, John. Where do you find new LPs? I mean, are you mostly having repeat business, or are you constantly networking, constantly meeting
It
new
is
people?
very weird. Yeah. No one comes and knocks on the door and says, "Hey, I hear you got these really crazy, interesting return profiles. Can I have some of that?" So it's an introductions business. It's a outreach, cold or warm outreach business. And you go and talk to folks and explain what you do, and if they like it, they give you some money, and you manage it as a fiduciary.
Right. So introductions wise, do you find are you having to be a mover shaker, go to events, or do you incentivize people to make introductions in some creative way? Because I know there's a
Well,
lot of Wild West when it comes to like
there's a lot of
fundraising and
Wild
SEC
West, and
regulations.
there's a
Mhm.
lot of Wild West. And you want to work with good people, and there's a lot of networking. It's as I said earlier, the job of a VC is to be a fundraiser first,
Yeah,
and
that's a good
then you might
line.
get to invest.
I like that. That's a good line. Um, where have you found, I mean, you've done funds overseas versus in America. What do you notice is the difference in the psychology between the two cultures in terms of investing?
There's quite a bit, um, and what I'm going to say is going to come over as glib and superficial, and it may be. Um, in the US, you have a startup that does X. Large established companies go, "That's cool. Let me use that."
Okay.
So there's an acceptance of innovation. There's an understanding of where innovation comes from, and there's a willingness to engage with, what is a small company. In Europe, it's more like, I'm of a certain size of company. What other companies my size use your product? Because I don't want to take the risk I'm using something my peers don't use.
Mm. So it needs social proof more so in Europe.
Right. And that is a real negative for innovation. The
Interesting.
other issue is a lot of the money in the space is government money.
Oh,
So a lot of
really?
the LPs of government funds that are sponsoring this and that and whatever. And so the VCs that take that money, are they taking the money to generate carry and returns? Or are they taking the money because they've got a guaranteed salary for the next decade? And that can be a negative incentive with regard to innovation because, they may say, look, I want to make sure I return the capital less than I want to return on capital. Because the LP, maybe I need to get a certain number of jobs in this country or this industry or whatever. And they're focused around that. And the LPs are very bureaucratic and put a lot of burden on them with regards to that. So that's some of the money that's there. But this social proof concept, which is somewhat in the US, we're not social proof investors, but it's very prevalent in Europe. So am I
Interesting.
investing with the smart VCs? Am I in the right club? And that also fosters, I think what's core and center of VC within US culture is the willingness to make high conviction bets that are out of consensus.
That's
And
fascinating.
Europe is more consensus driven. So, I mean,
So it's probably like a virtuous cycle then. If you are doing well with something, it's just really positive in Europe. Because if you're having that flywheel, then it just compounds, I would guess. Is that right?
right. But, Europe is also a highly regulated market, which makes it kind of difficult as well. But, from our perspective, if we make an investment, our first investment, and another VC like raises an eyebrow and goes like, "What are you doing?" We take that as a positive because we're
That's
early.
yeah. That makes sense.
So we do make now. I want to be very clear. We are wrong so often. Oh my God, it is so upsetting when we're wrong. Now,
I
we're not
bet.
as wrong as the average, but we're still wrong. We invest, and it's not just wrong. We invested in a company that wanted to be like the QuickBooks for immigration. Think about it, a SaaS product, so you can manage all your immigration
Oh
forms,
my. It
right?
sounds brilliant. I'm married to an Australian.
Unbelievable, right?
We did the immigration process. I have a niece trying to immigrate here now. It's
We
yes.
went through 3 CEOs and we couldn't get it to work.
Oh,
And still don't know today. And the first CEO,
that makes me
and
sad.
used to run immigration in the country, knew everybody, knew everything. I don't know why it didn't work. And it's great people who we had. It just didn't work. And I don't know today.
That's
So,
so sad. That sounds like such a great utility. I need that in my life with my family.
in VC, you need an iron stomach because you are wrong a lot of the time. And
Wow.
when you're right, it's amazing because you've really helped someone, in their 20s or 30s who probably didn't have a lot of wealth to become phenomenally wealthy, build a lot of jobs, change the behavior of millions of people, and create a fantastic business. But
Right.
you have to deal with it. And the earlier you are, the more wrong you are. So you've got a longer period, right? I told you this illiquidity.
Right.
Yeah.
Yes.
Yeah. It's a very, very strange business for sure.
That's fascinating. So, John, speaking of being right, what projects or what portfolio companies are you most excited for right now, and or have you
Well,
most had the most joy with in the past?
I have 70 portfolio companies, like having 70 children. So, I could talk about any of them, but I'm going to give you, I'm going to give you, um, let me start with one example. I may give you a second one. So we invested 5 years ago in a company called Manna, Manna, and it's last mile drone delivery. So the name was picked because if you remember your Old Testament, manna from heaven, right? So we thought it was a great brand name. But it wasn't the brand name we invested against. We invested really because of the CEO, Bobby Healy, just phenomenal guy. One of my LPs said, "You got to meet Bobby. He's got this crazy idea. You're probably the VC for it." So I sat down with Bobby, and after about 40 minutes, I said to him, I got a big problem. He goes, "What's your problem?" I go, "Well, I don't know if you can build the drones. I don't know what your economics of delivery are. I don't know if consumers will adopt. I don't know if businesses will adopt. I don't know if you're going to end up killing people." He goes, "Whoa, whoa, whoa, hold on a second. That's like five." I go, no, no, no. My big problem is, I think you can solve all of these.
Wow.
So we ended up leading the seed round. The company today is up and running in production in Ireland. They're doing hundreds of deliveries today. Their contribution margin positive. So they're actually making money on deliveries, which no one else is doing in the world. They have all the regulatory approval. They're effectively a regulated airline and a regulated aircraft manufacturer. So it's a very complex business. They have a European Beyond Visual Line of Sight license, and they're working on getting their US one. They're also they have a delivery set up in Dallas, Fort Worth as well. And when I look at this business, I think they can get their cost down to $1 to $2 a delivery. The
Wow.
cost for Uber and everyone else for putting someone in a car on a bike is between $8 to $12.
Wow.
So it's 1/10 the price. It takes sub 3 minutes to deliver. It's an
Wow.
amazing experience. Has net promoter score is top decile,
How
and
cool.
it takes so like you get your McDonald's, your burrito warm and fresh. They've actually delivered Guinness and egg.
No way. So
Yeah,
drinks.
yeah. They stopped doing Guinness because it was just taking up all the flights. People were like, every 45 minutes scheduling another 4 pints, and it was just eating up all their capacity. But no, this is great. I think
That's a cool name. That's a cool name, Mana.
it is a
I
cool
like
name.
it.
And it's
Hmm.
a great company. And, Bobby has really done a fantastic job. But when
And
we
it's only
invested,
in Ireland. It's just
well,
Ireland right now.
so it's an Irish company. Well, it's a
Okay.
US company based in Ireland. But we thought that was a great place to do it. Big enough test place. And
Yeah.
Ireland is in Europe to get the European license. As I said, there were a number of things that really lined up to make this work.
Yeah.
And it was a ridiculous idea 5 years ago. And now it's only a little ridiculous. But I think at some point this will become just so obvious to people.
So obvious.
The
Yeah.
demand for last mile delivery exceeds any way to do it other than by drones. And so I think the skies will be filled with drones. I would have told you that 5 years ago. So
Yes, I
this
agree.
is an example of these sort of high conviction bets that we made in companies. Um, so that's an example of one. Um, but again, I've got another 69 other companies I could talk about.
That's so fun. That's a really fun one to hear about. On a personal level, John, I mean, it's a lot of work running a VC, managing. How many LPs do you have on an average fund?
Less than 100, but we probably have 250, 300 LPs.
So you're dealing with a couple hundred investors, couple hundred, 100 companies or so, depending on where the cycle of some of your funds. It's a lot of work for four people. My goodness. So what does John do to keep this immaculately groomed beard? And tell me about your personal life, and what brings you the most joy?
I'm blessed with 6 children. They're all married.
Wow.
We have 14 grandchildren at the moment. Long-term compounding, right? And my oldest grandchildren are 10. So if they get married early and have kids, we'll be around for great grandchildren, which will be wonderful.
That's so fun.
I don't follow sports. I haven't had time. But it's kind of funny. When I was in my 20s, I was like, how do I be respectful to my mid-60s self? And so, I thought about this sort of various things that I wanted to do. And one of the things I wanted to do was not be retiring, kids leaving home, and health, sort of waning at the same time. That's like a triple win. And I'd kind of like seen that with others. So now I'm in my, I will say early 60s, but approaching my mid 60s. I say, what do I need to do to be respectful to my mid 80s self? And so I've really I've really stepped up. If you look at any of the books on longevity, it's around
Yeah.
sleep and diet and various things, but all of them in one way or another say you need to be an athlete. Now, for me, that's going to the gym because I think resistance training is very important. And so
Right.
I am spending more time in the gym this decade than I did the last decade, etc. And I think
Good on
my
you.
70s, I'll be spending even more time. So I'm now in the gym 3, maybe 4 times a week. Traveling sort of interrupts that. And I think in my 70s, I have to be in the gym, 5 times a week. Just a little side anecdote. When I was in my 20s, I read an article in The Economist that said, however much exercise you do, every year you need to do a little more because your metabolism slows.
Wow.
And
Yeah.
so my takeaway, whatever I was, 26, 28, however old I was I would do no exercise until I was 40. Because if I'm going to be on the conveyor belt, let's start it very slow, right? And,
I like this.
and honestly, I didn't go to the gym until 2007. That's when I first started lifting some weight. And now, I do 6, 7 hours a week. And honestly, it's transformative. There's lots of stats out there, but particularly for men, and I haven't studied women, but I'm sure there's similar stats. As you get into your 50s, the amount of muscle you have really depreciates. And, between 60 and 70, it's like 4% a year. I mean, it's just
Wow.
it's a ridiculous loss of muscle.
Wow.
But it's all discretionary.
Wow.
So so one of my objectives is when I'm 70 to have more muscle than when I was 60.
Nice.
And then try and maintain that. It's funny. I saw this YouTube video of Arnold Schwarzenegger being asked, "Why do you still go to the gym every day?" He goes, "I go to the gym to be strong." And then they go, "And?" He goes, "So when I meet death, I can beat the hell out of him."
Oh, cute. That's super cute.
But there's an element of like
It's the truth.
Yes, look, the hour you don't spend in the gym is an hour you're going to spend in a doctor's office when you start getting into your 60s. Things start catching up. So to me, family and grandkids are amazing. They're just amazing.
So fun. I love it.
And I tried to travel a bit. I love going to the U.S. national parks. This is just an amazing country.
It really
Working
is.
out and honestly, just trying to think about lots of new stuff, which is keeps your brain sharp, and that's why VC is a wonderful job to do in your 60s and 70s.
I bet. Keeps you so fresh and on the cutting edge of things. Well, thank you so much for coming on the show, John. It was such a pleasure to get to meet you, hear your brilliant insights, and learn more about the venture capital world. Thank you so much again for your wealth of knowledge.
Well, Lindsay, thanks for having me on, and I really appreciate it.
Thank you.
Do you need help with the next steps for your financial plan? Think Capita. Capita is a financial network built around you. They have a team of financial advisors, CPAs, estate attorneys, Medicare providers, and Social Security experts to help you accomplish your financial goals. Call to schedule a complimentary consultation at 801-566-5058 or visit their website at www.capitafinancialnetwork.com. You can also check out their financial education podcast, The Financial Call, available on Apple, Google, Spotify, and YouTube.